Let's start with some breaking headlines, though, from Fed Governor Lisa Cook in her speech on monetary policy on the Council of Foreign Relations in New York. And I'll do my best, Steve Leisman here, bring you some of what we've heard so far. Cook saying she sees evidence that trade policy is starting to affect the economy by increasing the likelihood of both higher inflation and labor market cooling. She also says the response from financial markets, businesses, and consumers to trade policy changes suggests risks to both sides of the Fed's dual mandate, and she expects a slowdown in the pace of economic expansion from last year's pace. I mean, maybe a 1 basis point back up in the 10-year on those remarks. Here to react, talk more about what's going on in the economy, Tom Simons is chief U.S. economist at Jefferies. Great to have you here. Welcome.
Thank you, Kelly.
We've sat through a number of big events the past couple months.
Yep.
Finally, here we have a chance to kind of digest everything that's going on. And
Right.
the JOLTS data this morning, I mean, the hiring, was it at what? Its highest pace in a year?
Yeah, and job openings increased as well. But trying to parse together the details of that, and you look at sector-specific things like with healthcare or food accommodation services and whatnot, it seems like, you had a drop in job openings, but then that sector had an increase in hiring. So it's like they filled the jobs, right? Quits fell a little bit, but, fell in areas where, with the economy is running very hot, right? Like trade and retail, retail trade, wholesale trade, manufacturing, all the logistics around the big surge in imports.
Not a problematic sign for you.
No one's quitting because they need to work, right?
Right.
So,
right.
I mean, I think that it was pretty steady state, which is very similar to what we've seen in a lot of
What
labor
month
market
is it now?
data.
June? So this was the April
That was
JOLTS
April,
data.
yeah.
Here's what's so interesting about the April data. It's been okay. For a month, they had one of the biggest headline shocks we've had in years in terms of the Liberation Day tariffs. The market absolutely tanked. That alone sometimes has an economic effect, and nothing.
Yeah, I think it's just a good reminder that a lot of the data that we see, we always refer to it as lagged because, we got April data in June. But it's also lagged because a lot of the things that make up that data would have been based on decisions that happened months ago.
Absolutely.
Right? So especially with hiring, and anybody who's ever tried to fill a position knows that it takes a very long time. The approval for it may have happened months and months ago. And by the time that person actually starts the job and will be counted on payrolls, it could be many months down from whatever.
Do you follow the more high frequency, like the LinkedIn or Indeed? I mean, sometimes those indicate. Do you see any? So do you think the JOLTS number is kind of real, or do you think that there is a slowdown happening? Because just this morning, Torsten Slok was out there with Distro List talking about could we be down to 60,000 for the next jobs report?
Right. And I actually expect that the number that we got on Friday is going to be pretty soft as well. We're only at 95K, which I think might be the lowest number in the survey. But I think that's more an issue of weather. It was very, very wet in May. It rained a lot, especially around the East Coast and throughout the southern United States. And May, being kind of like, prime spring season, is when there's a lot of outdoor activity, whether that's construction or leisure and hospitality. Maybe there's a little bit more slack, maybe, right? So I'm expecting that's going to soften things here. But, whether, JOLTS or the other more high-frequency data are telling the right story, I don't know that it's necessarily one that can be identified versus the other. I do think that it is very reasonable to expect that demand for labor is slowing as economic activity has come off. It was really a torrid run for quite a long time.
It's reasonable to expect that, but, it just, things feel like thank God, they feel like they're holding up okay in light of these massive moves, that we've had. So some of the consumer data points, even we were talking about, you can read the dollar stores two ways. Well, they're strong because the consumer's weak.
Right.
Then again, they also have a lot of discretionary involved. So it can't be that strong if things are really slowing down. So just trying to figure out what's going on. The GDP data is going to be really high, in part because of the import rebound.
Right.
Personal income was high, but that was in part because of the Social Security thing that Biden did. So it's like, but you strip all of that out, and it still feels like the core data is pretty good.
Yeah, and I mean, look at the equity market too, right? I mean, I think that something that's illustrative is that, at least as far as the detail that I am aware of, is that retail didn't really sell during the big sell-off, right? Like, this was a lot of institutional investors repositioning, but they weren't saying like, oh no, we need to now get liquidity by selling stocks. Instead, it was more buy the dip, as far as I know. So to me, I think that's also illustrative of the fact that people who have assets, who have higher incomes, are doing much better than those at the lower end of the spectrum. There's going to be winners and losers within the consumer spectrum in terms of like people substituting different higher or lower cost goods. That's going to continue as we see price increases and price changes from tariffs. But I don't think that there's any real evidence that we have a big loss of demand. And I don't think that we've seen enough cracking in the labor market to think that that's going to happen really anytime soon.
Have we seen enough for Fed rate cuts? Where's the market on that? And what does it mean for bond yields if that ends up not coming to pass?
So I don't think we've seen it yet, but if we get my number on Friday and then if we see subsequent weakness follow through in the summer, I think that maybe by September we could be ready for, a few rate cuts. But, as Lisa Cook mentioned, there's this inflation impulse from tariffs that's difficult to sort of balance against what's going on in the labor market. So you don't want to stoke all of a sudden low-cost borrowing, end up, preserving higher and higher spending. And
for sure.